Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and today I'm going to be doing our weekly market update. Got some interesting news, so let's go ahead and start sharing our screen here, and I'll share with you what's going on. Okay, let's get out of that. And so right now our inventory has gone up slightly. It was around in the 13,000s. Now it's in the 15s. Nothing crazy as far as an increase. We'd have to actually, in reality, at least double that to be in a truly balanced market. Things, this time of year, we kind of get a last minute rush at the end of the year, but overall, things kind of drop off seasonally. Unless we're talking about for the Phoenix area, our Sun City area where we may get some of our winter visitors and whatnot. But let's take a look at the overall stats, and then I will go ahead and get into some of the other details nationally as well as locally. So right now, we're 69 days closeout market, 3.47 month supply. A lot of that has to do with the increase and then the decrease in the sales that we're seeing, not only in Phoenix, but across the country. I'll get into more detail here in just a second, because it's really interesting what's going on with that. So, and a lot of people kind of have it a little backwards. So absorption rate, 28.78% of for absorption rate. The average list price is $796 and some change, and then the average sales price is $571, which definitely shows us that prices are increasing. At our list to sales price ratio over in the top right is 98.04, which is good. Anything kind of in the high 97, but really 98 or higher is always good, especially for Phoenix area. That's pretty standard. So we saw the increase, a 4% increase in our listings, which again, that is a good thing. So that was a little bit of a change, from week over week. Pendings are down, which I wanted to get into in a little bit more detail with you, because this is something that we're looking at, with some of the news going on. Let me just start over here. Okay, so the winter is this title of this article is "The Housing Winter Arrives Early as Existing Home Sales Crash, the Great Recession Levels, and the Long Feared Deep Freeze Sets In." Now it sounds like a horror story, right? But when you kind of dig into it a little bit more, and you kind of get into the clickbait headline, you start to figure out that, without boring you with all the details on the numbers here, that what they're getting at is we're really in more of a 1980s style market than we are in a 2008 market. Yes, the levels of sales have dropped off. And part of that is, again, seasonally. And secondly, we've got the increase, even though it may not be as fast as some people might want to see it, or some people hoping for the crash. But, obviously the interest rates are driving this, and we'll get into what's going on with that in just a second. But they're saying, we're seeing a drop off in sales, but it's more like back to the future. It's more like back to the 80s. And what we were looking at there, as far as the type of housing economy that we're in, with rising interest rates and inflation, and some of the volatility going on in the marketplace, and then we have this deja vu effect going on with, in today's market, it says it's not overbuilt like it was during the 2008 crash. We were way overbuilt. Now, just for the Phoenix area, I know I've said this many times before, but we were in the range of about 56 to 58,000 homes for sale when the crash actually occurred. I just showed you, that was as far as the inventory we had. I just showed you again, the whole MLS right now is at 15, even with that slight increase. And we've been lower than that up to this point. A lot of people are just kind of, jolted since about last April, May, with these rising increase in interest rates from last year of April or May of 2022. So, a lot of people are just seeing it a little differently as far as that's concerned. And where we're headed is not really expecting housing prices to fall over the winter. Okay. And the reason for that is the simple reason is it comes back to the idea of supply and demand. There just isn't an overabundance of homes available, which is another reason why things are slowed down. There's just not enough options for people, right? Maybe they're just like, well, I'll wait till I find the home I want. If I'm going to move, and if I'm going to get a higher interest rate, there's some of that going on. Or first time home buyers are waiting because maybe they were priced out of the market a little bit, waiting for wages to catch up, or waiting for more inventory, just not seeing what they want, and all that sort of thing is also another factor. So supply and demand, and it gets into the article just basically saying that we just don't have an overabundance of homes with people that are looking for homes right now. We also see that with the millennial generation, we actually have a lot more of a population looking for homes at the present time. So one other thing to point out is that it looks like, there's no guarantee, but it looks like that the next meeting on November 1st with the Fed is going to be, a likely hold on Fed's fund rate increases. So, right here it says the Fed likely plans to hold their current 5.25 or 5.5 range for a few reasons. And then it gets into the 10-year Treasury. Now, that 10-year Treasury, basically, it's what your economy revolves around in reality, because, when we see that go up, we'll also see rates go up. And that, again, is part of what we always talk about with inflation, right? Inflation goes up, mortgage rates typically will go up. And what the Fed is trying to do is destroy the demand in the marketplace for buying things, right? They want to slow the market down. One of the things that they're looking at is obviously then, this 10-year Treasury, along with other factors like employment. So really quick, let's take a look here at the unemployment. You can always find this, U.S. Bureau of Labor Statistics. Now, let's say, payroll employment rises by 336,000 in September. Okay. I'll come back to that in just a minute. Now, it says that the 10-year Treasury tops its levels once again. Here's what that means for you. So, we see, again, once this jumps, we see our rates jump, right? And today, they actually came down a little bit at 4.8. They were up to 5. Some people are predicting they may go up to 8. I don't know. We'll have to wait and see. But Treasury yields are slightly higher after key inflation data releases. So we've got all these readings in place, and then that obviously has affected our mortgage rates up or down. We were up, when it went up to 5, we're up at 8. Now we're at 7.8. We've got this spread between the two, of about 3%. And this is what I wanted to show you as far as the jobs numbers are concerned. So there's that 336, because again, they're trying to slow the economy down, slow all these factors down, right? New businesses hiring, or business new business acquisitions, product development, hiring, right? They want to slow the economy down because the inflation was out of control, right? That's what the Fed is trying to do. And there's only certain sectors of the economy they can control. Now, I also showed you another article last week, about a week ago, in one of the videos I did, that talked about a big component of this is energy, right? It's energy. But they're dealing with other factors that don't have to do with things like energy. Okay. They don't deal with things like food when they figure in a lot of these equations because they don't have any control over crops, and stuff like that. But they do have control over how much it costs to borrow money. And that's really what it comes down to. Now, the Fed's fund rate doesn't directly correlate with mortgage rates, but it does have an indirect effect because of the banking sector and how much it costs to borrow money in general, right? So they're looking at these jobs numbers and they're saying, boy, it's great. We're creating all these jobs, right? But look here, the revision past 2 months, all government increase, okay? All government increases over the past 2 months. So they're revisions, okay? And in reality, it's really a decrease of these real jobs of 885,000. September government job gains of 70,000 are teachers. So it's a seasonal adjustment, right? It's a seasonal adjustment. Teachers coming in and out of the workforce, with the summer downtime and all that. So a lot of this is seasonal. We're going to see a lot of this is part-time. Retail up 20,000, but we've got Challenger reports said sharp rise in retail layoffs. And this is heading into the holiday season here pretty soon, right? Leisure and hospitality up big, but hotel occupancy fell. Doesn't really sound like it's that strong, does it? Okay, so let's take a look at this chart. Unemployment rate remained at 3.8%, but when you break it down, jobs, jobs up 86,000, but full-time down 22,000. Past 3 months, minus 692,000, okay, of those full-time jobs. Past 3 times this happened, all led to recessions. Okay, when you look back in the recessions that we've had, the last 3 recessions. Okay, so part-time increased at 151, and multiple job holders increased by 123,000. So what does that tell you? That tells you that a lot of people are having to, maybe get a bunch of part-time jobs because they can't get a full-time job, or they're working full-time job and a part-time job or 2. Okay. I'm having to drive Uber because my regular job doesn't, give me enough money to live with this high inflation, high, a cost of living and everything. Because remember, we live on this, borrow money society, this debt society. So it's all based on that Fed's fund rate when that goes out of whack, right? When it goes up like it has. So when you break these numbers down, it doesn't look like a super strong economy. And it looks like it might be way past the time for the Fed to, take the foot off the brakes or take the foot off the gas. And we also saw a drop of about a half hour. Okay, it doesn't sound like a lot, but when you kind of, figure that and add that all up across the board, we saw a drop of about a half hour in hours of full-time employees. So all the indications are that it's not all wonderful as a lot of these news reports a lot of times would have us to think on the jobs numbers. So just ask people that are working out there, and want to know how the economy's doing. Well, you're trying to get a mortgage rate that's affordable. You're trying to go to a grocery store and buy groceries. You're trying to buy gas. Everything's very expensive, right? People know this. All right. So what does that mean right now and where we're headed in the housing market? Well, right now, we are in a seller's market technically. This is the Crawford Market Index. Anything between 90 and 110 is technically a seller's market. Okay. So 100 being completely balanced. I'm sorry. 90 to 110 is a balanced market. 100 being completely balanced. Anything below 90 is a buyer's market. Anything over 125, 110 is a seller's market. and we are at a market index of 125. So technically we're in a seller's market. The supply is at 57, which, obviously super low on the supply, as we've been talking about, and demand's gone up a little bit over time here, but it's still below where we like to see it at. So if these two numbers were the same, we'd be in a balanced market. This number actually had gone up all the way to about 165 back in the summer. So it's kind of dropped off. But again, a lot of that's seasonal. Overall, seasonal numbers are going to drop out, right? Again, one thing to clarify too, when you see these rate numbers, okay, these are retail average rates, okay, that you're going to see on these websites and in the news. If you go with a mortgage broker, which we like to deal with 99% of the time, they're able to shop the lowest rates, the best rates available for what you can qualify for, and they're going to charge you the least amount in fees. No junk fees typically. So we have some that we could recommend to you, that we like to work with, and that's just something to think about. And right now, with some of the rates that they're offering, I've seen them in the sixes. Also, new home builds. Here's just one chart that was sent over to me from a new home builder offering these sorts of rates. Now you can get these sorts of rates also. Again, that in the sixes with the mortgage broker, that's just like kind of normal rate with them, for over 620 credit score. These are rates that that I'm showing you here at 5.9, 4.9, 3.9. These are what builders are buying down, but a lot of times you're still going to be charged tons in fees. And typically we're seeing, with a broker, you're going to save about around 13, 14 grand with a mortgage broker versus a retail mortgage lender. So just something to think about. But with a builder, you are getting these rates. You can always, refinance later. But some of these are buy down programs. Some of them are offering different concessions. So every builder is going to be a little bit different, but this is just one example that I like to show. So with that, let's take a look. I'm going to take a quick look here at the cities in our Phoenix metropolitan area. All of our cities are actually right now in a little bit, as far as the seller's market's concerned, they're kind of going down from in the Cromford Market Index that I showed you earlier. That was at 125. So technically we're in a seller's market overall for the greater Phoenix area. Well, all the cities pretty much in the whole Phoenix area are going to be in a seller's market right now, or they are in a seller's market right now, except for, let's see, five of these, except for five cities. So the cities that are not technically on the index in a seller's market are Surprise, Maricopa, Queen Creek, Goodyear, and Buckeye. So if you're a buyer in those areas, you have a little bit more of negotiating room. Again, with pre-owned homes or resale homes, we can get you a lot of times these buy down rates that I just showed you for the first 2 or 3 years, with our lenders. So you could still get low rates. And again, when the rates do drop, and a lot of times we ask, well, when are they going to drop and what are we looking at when they drop? Well, are we going to see 3% again? I think we can get 3% out of our mind. People say, well, should I buy now or wait? Waiting really is only going to save you in reality, very little. When you look at comparatively to the increase in home values, okay, and the compound effect when you own a home, with your tax breaks, the increase in value, paying down the principal, all those sorts of things. And you figure just conservatively, even a quarter to 0.5% a month, nationally right now, they are predicting, right around a 4.8 to 5% across the country over the next year. I'm going to tell you, my prediction is, I think people are going to kind of get used to the higher rates after about 3 or 4 more months of this, because we're going to almost at that point be about a year into these higher rate thing that's been going on. And again, historically, these are not crazy rates. I mean, back in the 80s, they were up to 18%. So I think we're going to have about 2, 3, 4 months of this more, and then we're going to go right back into the busy season. It's been at that point 2 years of these rate increases and stuff. We should also see the fact that we're already going to be in recession because of what the Fed has been doing, being late to the party. They could have stopped this a long time ago. They started late and they went crazy with it. Now they've gone too far. You've got economists running things you got attorneys running things versus economists and all that at the Fed. And they're looking in the rearview mirror, except, instead of what's going on now with actual, in the marketplace with jobs and all these other factors. But so I think people are going to get used to it. We're going to head right back into the busy season, right into tax season, and then boom, people are going to be, kind of used to it. They're going to get off the fence and start buying. Now, that said, I think we'll see some reductions in, the rates and things over the next year. So probably around the third and fourth quarter of next year, we should see that. Those are the projections. Again, we're not going to see 3% rates, but if these retail average rates that you see on these websites and out there, and this general information on the news, drop into the 6s or 5s, that would be amazing, right? Because then that means, with a mortgage broker, you're going to be getting, even less than that, maybe up to 100 basis points, less than that, plus less fees. So just something to kind of, again, that's just what I'm thinking here with, because in every recession, we see these mortgage rates go down. It's just how it works. Bad economy equals and recession equals lower mortgage rates. Okay, eventually. So, and right now with the pace that we're seeing, it's crazy. We had a little bit this past January. We had a little bit of a fall off on housing prices. We kind of hit rock bottom around December, January. Now we've seen, from Case Shiller, CoreLogic, Black Knight, Zillow, FHFA, all these different companies and organizations are showing us anywhere between a 5 to 10% increase overall in equity, across the country. So, our equity gains here are always higher than the average. I think next year we're probably going to see anywhere from 10 to 15% increase in equity. So people ask me, should I wait to buy? Should I buy now? Well, waiting for a lower rate is actually going to cost you money when you look at the equity gains and what you could get right now in a price. And then if you get the buy down or you go with a broker, and all that, it's even better. Also, if you own a home and you want to move and you can, most people right now have an average of about $200,000 in equity. But credit card delinquencies are up about 50%. So, not that everybody's in the same boat there, but if you're looking at the averages, if you took that money, part of it for your down payment, maybe a little less for your down payment even, and paid off some of those higher interest rate credit cards and loans that you have, well, then, in reality right now, you're not paying, you're not sitting there with a 3 or 4% rate on your home because you're paying all these other credit lines at a much higher rate of, 15, 20, 22%, whatever. Pay those off and now move and move on, right? And actually have an overall lower revolving debt every month. So just an idea there. But when you look at the credit card delinquencies and what people have in their homes, it might make sense to, do a cash out refi or HELOC or move on if you want to move and go from there. So if you have any questions on that, let us know. But those are just some ideas on that. But the I'm sorry, the average equity is actually 249, not 200. So anyway, but if you bet against the champ, as far as the housing market's concerned and in your investment and how to build wealth, you look over time, obviously, owning a home is the way to go. If you're going to be in a place for only a year or two, probably not so much. But if you're going to be there at least 3 years or more, it would definitely make sense. So, guys, I think that's really about all I have for today. If you have any other questions, feel free to reach out. I'd love to be able to help you with any of your real estate needs, to answer any questions you might have. And we've got some great loan officers that can help you with the mortgage side of it. And if you're looking to buy or sell a home, we can certainly get into the details of that and see if it's a good fit for you to work with us and how we sell homes. So, guys, if you have any questions, it's 480-788-8569. Check us out at MancolaHomes.com, MancolaGroup.com, and you can always email us at home@MancolaGroup.com. We'll talk to you guys next time.